do you think we might have already seen the peak in this yield curve for this cycle?
Yeah, I think we saw the peak of yields at the end of March, John. And what's happened since then is the market just repricing to the reality. Rates aren't going up anytime soon. To me, I wonder what's happened to the 2% and above consensus forecast, because to me that wasn't particularly robust in the first place. So I think that there could be a scrambling of people's forecasts, as you have seen some people scramble to cover their shorts. So, pushed, if yields are going to move towards 1% or 2% through the rest of the year, I go for 1.
Steve Major, we've got an awful large audience of listeners and viewers that don't have a CFA. They didn't study Fibonacci cover to cover like you did. And they're going, wait a minute, debt up, ever higher. And as you brilliantly show, yields continue to fall. That is the arch conundrum. How can that be?
Well, first of all, the last 20 years have seen that association of higher debt and lower yield in place. Now, of course, the correlation is not causality. To go to causality, you need to think about the debt servicing channel. And that's the cash payments that have to go towards servicing the debt. The simple point, Tom, is we cannot afford higher rates. And it's very, very unlikely that we will reach the height of the last cycle. Now, that seems to me to be more important than the date of the liftoff. It's the destiny that really matters, not the departure.
Stephen, how much does this rely on an ever-easy Federal Reserve versus just the dynamics natural in the economy?
Well, look, the Fed's easy in several ways with forward guidance and the QE and the interest rate that it sets. And that sets up a bit of a trap because it's very, very difficult to unwind all of this. So the debt stock is huge globally. The interest rates are low and there is QE, etc. So it's going to take a long time. Think about a supertanker turning around the Cape of Good Hope. I mean, it looks to me it's going to take a very long time. And that speaks to today's testimony. I mean, at best, you might get an iterative shift at some point, but nothing dramatic is going to happen today. It can't.
Steve, a lot of conversation about the reaction function over at the Federal Reserve. Let's talk about the reaction function of the market participant to data. Yesterday morning got a lot of attention from a lot of people. It wasn't just the CPI print, it was how the market responded to the CPI print. Didn't last too long because, as you know, we had a messy 30-year issue a little bit later in the afternoon that changed things up. But your read, just in that period, those several hours after that inflation print, what did that tell you?
Well, I think the market is displaying a sort of Pavlovian response to all of this, in that it knows that if the probability of rates going up is to increase, as it seemed to have done at the June FOMC, then equally the probability of reaching the heights of the last cycle are also going down. So to me, the earlier they hike, the less room they have to go up. They'll have to stop earlier. And I think that's how the market is now understanding the Fed's reaction function. They have this flexible average inflation targeting, but they've sort of chopped off the right tail by indicating that they may hike in 2023.
Steve Major, if we have a boom economy, whatever the numbers are, say Goldman Sachs is far apart, more optimistic than Capital Economics, which is more cautious, HSBC doing their own work as well. If we have a truly boom economy, can yields go up with a boom GDP and everyone remains happy?
Very unlikely that yields are going to go up, even with strong growth. If you get a 6% growth this year, you have to weigh it against the -2 from last year, so the average is +2. And look, as your show has been pointing out, real yields have been falling because they are the shock absorber that comes through. Nominal yields are being controlled. If inflation expectations and risk premia rise, the real yield can only go down. That's all that's happening.
Stephen, if you see that bond yields can remain low while this is a boom economy, does that mean that bonds have lost their signaling power, that they don't have the same kind of predictive view on the economy that they've traditionally had?
Yeah, that's a deeply involved, complex question. And I would say that when yields were down at 50 basis points last year, they lost a lot of that signaling, and also they lost the diversification benefit. But when we're at 140 or so, then there are investors who will buy long bonds. Long bonds anywhere near 2%. Offer ballast in a portfolio. So in terms of signaling, I think maybe people are over-interpreting what the yield and the yield curve means, because look, we've had a decade or more of QE and unconventional monetary policy. Well, of course, some of the stuff from the 70s and 80s, that doesn't really apply to today's economy and bond market.
So Steve, just a final question from me, if I may. You and I have known each other a long, long time, and I know that you've been right more than you've been wrong on this bond market. Someone just reached out to me and said exactly that, and they asked the question, what would it take for the 2% crowd to be right? What would it take ultimately for you to be wrong and the 2% crowd to be right? What do you think would need to happen?
Well, there needs to be something more durable on the employment and wages side. And I think that this is where the Fed is very inclusive. And in answering the questions, I'm sure that Chair Powell will point to that. The Fed is helping ordinary people by getting them back to work. We're a long way from seeing durable increases in wages. That might change the inflation outlook. So I would put that as one of the risks. I guess you could have personnel changes that we're not predicting in the next year or so. So, personnel changes at the Fed. I'm not really sure how problematic that will be. But the point is there are always tail risks to the forecast, but we're trying to take that into account. There's also a risk that yields go much lower, by the way.